Welcome to the Deep Dive. We're talk tickers, and our job is really to cut through the noise of earnings calls.
Right, and pull out the insights that matter for you, the experienced investor.
Exactly. So today, we're jumping into Fulton Financial's second quarter 2025 earnings call. We've gone through it, and the goal here is simple. Give you a clear, concise overview of what's really important from their results. No need to dig through documents yourself.
Let's get straight to it then.
Okay, starting with the big numbers. Fulton reported operating earnings of $100.6 million. That's 0.55 per share.
And that's a record for them, right?
Yeah.
First time over the $100 million mark for operating net income in one quarter.
It really is. Speaks volumes, I think, about their operating leverage and how they're managing the balance sheet.
Definitely positive signs there.
And they were active with buybacks, too. Repurchased about 522,000 shares.
Now, what price was that?
Weighted average was $169. And this wasn't just window dressing. It really helped drive tangible book value per share up. A pretty impressive 9.5% annualized growth, linked quarter.
Wow, okay. That's a solid return to shareholders. And how do those numbers stack up in terms of ratios?
Well, the efficiency ratio came in at 57.1%.
Which is, pretty decent. And the returns? ROAA and ROITCE.
Right. The operating ROAA ticked up to 1.3%.
Okay.
And the operating ROITCE increased to 16.26%.
16.26% on tangible common equity.
Right.
That's strong. That suggests good capital efficiency, especially compared to some peers.
Absolutely. And overall revenue was up too.
Driven by both NII and fees.
Yeah, growth in net interest income and fee income. And it looks like they kept a good handle on expenses.
Makes sense. What about the balance sheet basics, loans and deposits?
So total loans grew $150 million. That's about 2.5% annualized.
Modest growth.
And deposits.
Deposits actually saw a slight dip, down $191 million, or 2.9% annualized.
Okay, so that puts the loan to deposit ratio
right around 92%, still comfortable.
92%. Okay, so headline numbers look good, ratios are solid. Yeah, but for a bank, the devil's often in the details of how those loans grew and why deposits shifted.
Exactly. What was underneath that $150 million loan growth?
Well, it seems the main drivers were residential mortgages, home equity lines, and also some specific commercial categories.
So targeted growth, not just across the board.
Precisely. And interestingly, this was partly offset because they strategically let their indirect auto portfolio run off a bit.
Managing risk there.
Yeah, and they also trimmed back some other commercial loans deliberately. It shows a focus, I think, on credit quality and where they want the portfolio to be.
Makes sense. What are they guiding for the full year on loans?
Still expecting low single-digit growth. Seems pretty prudent given the environment.
Okay. And the deposit side, that modest decline? Any color on that?
They mentioned it was largely seasonal, typical municipal balance outflows.
Right, that happens.
And also a decrease in non-interest-bearing balances. Those are now about 20% of total deposits.
Okay, so a bit of a mix shift, perhaps. Did anything offset those outflows?
Yeah, they saw increases in money market balances and also tapped some wholesale channels.
Right.
And they do expect those municipal balances to flow back in during the third quarter.
So managing the funding mix actively, volatility in munis isn't unusual, but good they have other levers.
Definitely. Now let's connect this back to the income statement. How did all this movement affect net interest income and that margin?
Good question. NI did increase, landed at $254.9 million.
And the margin?
The net interest margin, or NIM, it edged up 4 basis points to 3.47%.
Okay, what drove that margin expansion, even with deposit competition?
Well, loan yields held quite steady, actually, at 5.86%. Plus, they benefited from some fixed-rate assets repricing higher. That was a tailwind.
But I sense a but.
Yes, there's always a but, isn't there?
Yeah.
That benefit was mostly offset by lower accretion interest from that Republic portfolio they acquired.
Right. How much lower?
It declined by $1.7 million compared to the prior quarter. It's now at $11.4 million. So some of that initial boost is just naturally wearing off.
Normalizing. Okay. What about the cost of funds? Deposit costs?
Interestingly, the average cost of total deposits actually went down 5 basis points. Came in at 1.98%.
Down in this environment.
Yeah. And they highlighted their through-the-cycle deposit beta is only 28%. That points to a really sticky, cost-effective base historically.
That's quite low, but can that last?
Well, management themselves acknowledge competition for deposits is heating up, and their goal is definitely to fund future loan growth with customer deposits, not wholesale.
So maybe that decrease in cost is temporary or nearing its end.
It certainly suggests they might be approaching a trough in deposit costs. Even with that strong history, the pressure is building.
Something to watch. Anything else impacting NII outlook?
Yeah, one other item. They had $195 million of subordinated debt reset. It went from a fixed 3.25%
Ouch.
to a floating rate based on SOFR, around 6.6% now. So that'll add to interest expense going forward.
Right. So the NII outlook overall.
They're guiding for steady state, modest growth, assuming the Fed stays put for now. But they're clearly flagging those competitive pressures on yields and spreads.
Okay, that sub-debt reset is definitely a factor. Shifting gears a bit beyond the core lending, how did non-interest income look? And expenses?
Non-interest income was actually a really bright spot, $69.1 million.
That sounds strong.
It is. If you exclude a one-off item from Q1 related to an equity investment, the linked quarter growth was broad-based, up 7%.
Wow. Where did that growth come from?
All-time record quarters for both wealth management fees and commercial banking fees.
Impressive.
Plus solid growth in consumer banking and residential mortgage, too. It really shows those diversified businesses are consistently contributing in a meaningful way. That's clearly part of the strategy.
Diversification paying off. Okay. And the flip side, expenses. They've talked a lot about that Fulton First initiative.
Right. Operating expenses were $187.6 million. That was actually up slightly, about $4.8 million from Q1.
Up. But didn't you say they managed expenses well?
Well, yes, because that $187.6 million was actually below their guidance range for the second half.
Ah, okay. What's the guidance range?
They confirmed $190 to $195 million per quarter for Q3 and Q4.
So Q2 came in lower, partly because of timing, maybe merit increases.
Partly, yeah. And the guidance for the rest of the year includes some room, some optionality for potentially new initiatives, so balancing cost control with investment.
Got it. And Fulton First, how's that tracking?
It's doing very well, actually. They realized about $8.5 million in net benefit just in Q2.
$8.5 million net.
Yeah, which means they're pulling forward those savings. They're way ahead of the original target, which was, I think, $25 million net for the full year 2025.
So we're exceeding expectations on efficiency. That's good execution.
Definitely speaks to management's agility.
Okay, efficiency looks good. What about the fundamentals? Asset quality, capital. Always crucial.
Agreed. Provision expense actually came down this quarter to $8.6 million.
Lower provision. Okay.
And their allowance for credit losses ratio remains strong at 1.57% of total loans. That covers non-performing loans by 177%.
Healthy coverage. What's the overall credit outlook?
Management is still cautious, given the economic uncertainty, geopolitics, all that. But they stress that the portfolio performance itself is steady.
Any specific pockets of concern? I saw non-accruals ticked up slightly.
They addressed that directly, said it was mainly due to one specific loan, a mixed-use commercial construction project.
Just one loan?
Primarily, yes. And they emphasized it's identified, it's appropriately reserved for, and they're actively working on resolving it. So it seems contained, more like vigilance than a systemic issue.
Okay, that context is important. And capital levels?
Very solid. Common Equity Tier 1, the CET1 ratio, increased to 11.3%.
Strong buffer.
Yeah, and they generate about $55 million in internal capital, adding to total equity. Their plan for capital is pretty clear, too.
What's the priority?
First, support organic growth. Second, any corporate initiatives. And third, opportunistic share buybacks.
Makes sense. How much is left on the buyback authorization?
About $115 million.
Yeah.
So they have capacity there if they see the opportunity.
Okay, solid capital, managing credit carefully. And they updated their full year guidance for 2025 based on all this, right?
They did. And a key change was their rate forecast.
Fewer cuts assumed now.
Exactly. They're now assuming just 2 25 basis point cuts this year, September and December, down from 4 cuts they previously baked in.
Okay, so how does that change the financial outlook?
Well, it led to an increase in their net interest income guidance, now expected between $1.005 billion and $1.025 billion.
Higher NII guide despite fewer cuts.
Interesting. Due to balance sheet dynamics.
Presumably reflecting the starting point, asset yields, and maybe slower deposit cost increases than feared under the old forecast. They also lowered the provision expense guidance.
Lowered? To what range?
Now $50 million to $70 million for the year.
Reflects that steady credit performance. What about fees and expenses? Fee income guidance is unchanged. $265 million to $280 million, but they did hint it might trend towards the top end of that range.
Reinforces the strength in those non-interest businesses.
Exactly. And operating expense guidance was also lowered, now $750 million to $765 million, likely reflecting that Fulton First outperformance.
Okay. Any other tweaks?
Just the effective tax rate guidance ticked up slightly, 18.5% to 19.5%. And non-operating expenses were lowered a bit, from $14 million down to $10 million.
So overall, a more positive outlook, factoring in a slightly different rate environment.
Yes, more conservative on rates, but more confident on NII, credit, and expenses, it seems.
So let's step back. For you, the investor listening to this, how should you contextualize Fulton's performance and strategy in the current market?
I think the key takeaway is their disciplined approach, that diversified loan book, growing categories prudently. It seems designed to navigate this kind of environment with competitive pressures and economic question marks.
They're not chasing growth at all costs.
Exactly. And something to watch closely, I think, is their commentary on loan pipeline pull-through rates.
Why that specifically?
Because that can be a really good real-time signal of broader customer confidence. Our business is actually committing to projects given concerns about tariffs, costs, the general economy.
Good point. What about M&A?
Their strategy there seems consistent. Focus on smaller, in-market community bank deals. It's more about targeted tuck-ins than big transformational moves, which fits their overall prudent approach.
So strategic balance sheet management, disciplined growth, proactive capital allocation, it paints a picture of a bank navigating carefully but confidently.
I think that's fair. They're reacting to the market, but clearly sticking to their strategic plan.
Okay. We've covered the performance, the strategy, the outlook. Now for a bit of fun, but with a disclaimer, our not financial advice segment.
Right. Strictly a thought experiment, not a recommendation.
Absolutely. Based on everything we've heard from Fulton's call, what's an outrageous but maybe plausible trade idea that springs to mind? Like something a hedge fund analyst might pitch.
Okay, well, given how consistently Fulton is growing that non-interest income, the wealth fees, the commercial fees, and how that's becoming such a core part of their revenue. And you contrast that with their, let's say, cautious commentary on loan spreads and the general credit environment. An outrageous but plausible idea could be a paired trade.
Okay. Long what, short what?
You could think about going short banks that are really heavily, maybe overly reliant on just traditional net interest income, the ones most exposed to margin pressure.
Right.
And pair that with a long position in banks like Fulton, the ones proving they can generate robust, growing, diversified fee income streams quarter after quarter.
So betting on diversification and fee generation over pure rate sensitivity.
Exactly. It's a bet that in a future where lending margins might be structurally challenged, these diversified revenue streams become the key differentiator for profitability and outperformance. It's banking on strategy over just spread.
Interesting angle. A bet on business model resilience. Okay, let's wrap this up.
Sounds good.
So to quickly recap Fulton Financial's Q2 2025, really a story of strong operating performance, hitting that record profit number, very strategic management of the balance sheet, and a credit approach that seems, cautious but resilient.
Yeah, a solid quarter overall. And maybe a final thought for you to chew on?
Go ahead.
Think about Fulton's updated guidance, especially that shift to expecting fewer rate cuts. How does that change your view on deposit costs and NIIs across the whole banking sector? What might it signal about the macro picture for the rest of 2025? And maybe how will other banks adjust their strategies now?
Good questions to ponder. And just to reiterate, everything discussed here today is for informational purposes only. It should definitely not be taken as financial advice.
Please do your own research.
We hope you engage with these insights, though, and think about how these trends fit into your understanding of the financial landscape. Thanks for joining us on this deep dive.